Hey everybody, John Duncan here. Just wanted to check out doing a live, and I wanted to review a book and an investment strategy that I developed off of a book called Snore Principle by Richard Koch. Now, you will remember Richard Koch if you've ever read the book 80-20, the 80-20 principle, which is the Pareto principle. And he didn't create that, but he wrote the book on it. So most people will remember him from that. But before all that, he was way back in the 1960s. He worked for a company called Boston Consulting Group, and they were one of the first companies ever to do what's called, business strategy. Like they'd be the strategists that come in and work with companies to create something, cut costs and get more efficient. And he's a self-made person. And according to the Sunday Times of London, he is currently worth $533 million. And he attributes most of that to what I'm going to share with you today. The STAR principle is very simple, and I'm going to walk through it, and then I'm going to give you some examples. The STAR principle is to look at a company, and this could be whether you're buying the company or if you're just looking to buy shares in the company. And so the STAR principle is basically this: they have to be a market leader. They have to be growing by at least 10%, preferably more. And they have to be in an industry that's growing by a minimum of 10%. Now, what I think is super powerful about this is I've been in investments and financial industry for almost 30 years and went to God knows how many training courses, and nobody I've ever ran into focuses on the industry growing. But if you think about it, an example would be like the solar industry, because it goes up and down, based on tax laws and so forth. And if you're in at the right time, make a ton of money. If you're in at the wrong time, make no money. Another example would be like the insurance industry. The insurance industry has been around forever and grows at like 1% to 2% a year. So it would not meet the formula for a star company. Even though the company could be growing by 30, 40%, the industry itself is not growing fast enough. And as we go along here, this is going to be pretty short, but as we go along, you're going to understand why that's so important. So with that said, I made another slide here because this kind of explains it a little simpler. And when he had left Boston Consulting Group, he was with them for 5 years, Richard Koch. And back in the 60s, could be drug fueled, I don't know, like back in the 60s, they had developed a formula, but it was internal inside their company. And it was essentially a formula to determine who they were going to put money with to develop as companies. Because according to the book, essentially they were coming in, and if they'd find a really good company, they were deciding whether they would fund the growth and expansion of that company, maybe even buy, a majority share or the whole company and just grow it. And they developed this little grid, if you will. And you could see here, this on the left side here, this is the annual growth rate for the actual company. And then these down here, this is 1x, 10x, etc. That is the sales inside the niche. And then it's also showing the sales of the next or biggest rival in the next niche. Now, I'm just going through this really fast, but going back to our talk here, market leader, not follower. You can see the star is up here. They're growing fast and they're in an industry that's growing super fast. What does that create? That creates what he calls geometric growth, where if you've got a company growing by, say, 50% a year in a market that's growing by 20% a year, the returns can be 100 to 1, 300 to 1. It can be huge. So very, very powerful. And I actually had read this several years back, and I put it to the test with a lot of different holdings, and I just wanted to see if it worked the way that he said, and it worked excellent. I'm going to give you some examples here. You can see, here's one that we all know, Amazon, and I'm comparing it to Netflix, and this down here at the bottom is the market itself. Like that's the S&P 500 right there in the super light blue. The blue is Amazon here, and then you see Netflix. And what's interesting is Amazon and Netflix are both stars in their niche. They're the leader, and they're in fast-growing industries that are expanding very fast. So as you can see, based on what Richard Koch had wrote about, the market over the last 5 years, that's what I went back here, we're going to do 5 years. 5 years, you can see the market grew by 53%. I mean, for the market, that's pretty good. That's broad-based. But you can see Amazon's grown by 437%, so, 8 times as much as the market itself. And then you got Netflix. Now, you'll notice there's some, wide ups and downs in here. But the other way to look at it is if it's a star, it's a market leader in a growing industry, a fast-growing industry. Even as market dips, you see big ups as well. So very powerful. Now, another point that he made in the book was, if we go back to here, you have stars, you have a question mark. The question mark is the follower. They're the ones that are, if you were buying a business, could you buy the question mark and overtake the star? That was the question they had. A cash cow over here, they're leaders in a low growth market. That would be like an insurance company, but they're a leader in that industry or in that niche, in that type of insurance, if you will. And then the dogs are followers in very low growth markets. But what's interesting is even when, a lot of times you'll have a company that it itself is growing super fast. And a point that he makes that's super interesting is that as strategy consultants, which ended up being, equity investors with a lot of companies that they found that were great, when the industry itself would start failing, even though the company numbers were very good, they would sell that company, knowing, unlike anyone else that was buying it, that the geometric growth would end soon because the industry or niche of the industry was not growing at 10% or more per year. And he gave some examples in the book where essentially they would sell a star because of that fact that the industry itself was starting to slip. And then the new company would buy it, hold it for a while, well, the price of that company would go down dramatically. In some cases, they would go back and buy it back. So they would own it, make a ton of money, then sell it, and then buy it back, which was super interesting. So he gave some examples here of actual star businesses: Amazon, eBay, Microsoft, even Dyson, the laundry, or not laundry, the sweeper vac, the cool thing that came out several years ago. Apple, because they operate exclusive niches where they're the market leader and draw a significant price premium. Uber is a star business, albeit they're in danger of losing their dominance. Facebook is a star business. Google is a star. Google, it's really interesting. I mean, if you think about Google, you don't even think of other search engines. Obviously, there is other search engines, but Google is just gigantic. I don't know what the percentage is of how many searches go on theirs, but it's got to be probably 90% or more are done by Google. Waze, YouTube, those are star businesses, but you can't buy, and even at WhatsApp, you can't buy shares in them anymore because they were bought by Google, and WhatsApp was bought by Facebook. Star business don't need to have anything to do with technology. It just so happens that as technology keeps expanding and changing business completely, that's why a lot of them today are based in technology. But an interesting side note that he mentions is, what is the longest running star business ever? And they're based in Atlanta, if that gives you any hint. The longest running star business is Coca-Cola. It was incorporated in 1888 and has been a consistent star business until the 1990s. So they ran from the 1800s to the 1990s. For over a century, 2 world wars, stock market crash in 1929 and Great Depression, Coca-Cola remained a star. So, bottom line, stars really have much stronger potential than just buying, what a lot of people do is, obviously you don't want to put all your eggs in one basket. But when it comes to finding good places to put money, if you can find stars, and it's not impossible to find. Let me find my notes here. About 5%, according to Richard Koch, of large companies' product markets grow at 10%. For new ventures, it's about 20%. And then you've got to look at niche leader. Are they the niche leader? Now, by niche, he means they're in a definable niche. You could be in the construction, industry, but break that down into several, like thousands of niches within the construction industry. But you have to be definable and not in a broad-based market. It has to be definable, and you have to be by far the market leader. Number two, which is super important, and again, something that I've mentioned this to, hundreds of advisors over the years, and I work with very smart and very wealthy clients. I've mentioned the STAR principle and the work I was doing researching this over the years. I've never had not one, that before I showed the results and so forth too, that knew what this was about, that had ever read the book, number one. And number two, going back to this here, everybody wants to talk about previous return when looking at an investment. Nobody talks about, are they the defined market leader? And number two, is the industry that they're in growing by a minimum of 10%? Now, just some results, and this is past results. When I first read this, I did a 12-month and a 24-month study on this, and I just went and I made sure that I had holdings that met all of these credentials. And out of the group of it was like eight stocks that I was tracking on it. The return was over 300. It was 332%, I believe, in 12 months. And again, that's just past. It's not, today. I'm not guaranteeing the results on it. I'm not saying that. I'm saying that's what my study produced. And I've been developing it for clients as well. The returns have been, very good. The bottom line is with it, just as an aside, if you owned, get to this, 5 or 10 stars and held them, even if 1 or 2 of them either don't do good or whatever, even if they went completely out, it's the other ones that make up for it. And what the problem is when I see like say you bought, everybody says go buy the S&P 500. Let's just say, for an example, that's kind of the go-to for a lot of people, which there's nothing wrong with that. That's a smart move. It's a broad, and it has a lot of great value to it. The problem with it, though, the downside, when comparing to the STAR principle, as Richard Koch is talking about, is this, that you own 500 different companies. And in that, you've got, yes, you're going to have some stars, but you're going to have some duds as well that are in industries that are not growing, that just don't match. They don't match this. You're going to have a lot of companies that aren't total market leaders. They might be leaders within a group, but they're not the definable market leader. They're in industries that are either not growing by 10%. They might even be just flat, or they might even be receding. Their industry they may be in that's not even growing at all, like going backwards. But they might be the market leader, and they might be numbers wise for their own growth, might be doing well. So they're in the S&P 500, but they're in a dying industry. And in that case, they don't meet the STAR principle. So what I'm saying is there's a lot of dilution in most portfolios that I come across. They're diluting. You've got the winners offsetting the losers, and a not as strong return as it could be. I believe, don't quote me on this, but he worked for 5 years with Boston Consulting Group. Then he went out on his own, and within 5 years, he had made over $100 million simply using this formula. Now, he was actually buying equity ownership of companies and blowing them up, making them market leaders. They were already really good at what they did, and he took them and got market share and so forth. So in some cases, he turned them into the stars because he saw the value. They were essentially question marks that he turned into stars with his knowledge. But others, he didn't really get involved at all. He just knew that they were a start business based on the dynamic, based on the growing in a growth industry, and geometric math took off. And what's interesting is he says as well in his book that everyone that he's ever shared this with that has used it has all made tons of money. So it's coming, even he says that. But the question that I would have if I was watching this is this: well, why isn't everybody using this? And he says what's really interesting is back when this was developed, that this was internal. This was internal to Boston Consulting. And some of the companies that they worked with learned about that this was going on, that they were investing heavily in stars, and maybe some of the companies weren't stars, So they weren't getting allocated the resources that the stars were. And so it was just one of those dilemmas where they just scrapped the whole thing. They scrapped this whole grid because clients had gotten mad because maybe some of the clients were dogs and they weren't getting the funding that they thought they needed. And so anyway, as he says, they threw the baby out with the bathwater because some people complained. He took the strategy, went on out. My take on it as well is, the financial industry is all about, promoting itself, that it has answers that are super sophisticated that nobody can understand. And the reality of this is really quite simple. It's just a simple formula, and it's common sense. If you've got the market leader that's growing by 10% or more, preferably 20, 30, or 50% a year in a growing industry, your odds of having a very good investment are sky high. And as Richard says, it's geometric math. It's not 1 + 1 = 2. It's 1 + 1, market leader growing by 10% in an industry growing. It could be, 500 times to 1 or whatever. I always think about it. I love basketball, and it's like having, 3 or 4 Steph Curry shooting 3-pointers from all over on your team. It's pretty hard to lose games when you have people that can shoot that well. And that's what the star companies are. They're, even in a bad economy, they may go down for a minute, but they're not going to stay down because they are the leader in growth industries that are growing by 10% every single year. And then with his formula, not only do you know where to find winners or high probability of winning, you also know, if you stay on top of it, when a industry starts fading. And in today's world, that's the big thing, because we're in a fast-paced world. I mean, with technology, entire industries can change overnight. That said, knowing that an industry has faded, even though the company's numbers may be super strong. I mean, going back to this right here, Amazon. I mean, when tracking companies like this, you got to keep an eye on, is the industry, are they still the leader, and is the industry changing? I mean, what if a different Amazon came along that blew them away, or the industry that they're in started to fade? Then you've got a problem, but the rest of the world may not know it. The stock price might be an all-time high, but you know it, and you know it's time to sell or sell short or whatever you're going to do. He did mention as well that what is the downside? Is there any flaw or fatal, something you got to look at here? And that is what he talks about. It's not really a flaw. It's more about the pitfall of a star venture. And there's only one, as he says, but it's huge. The trap is that a star stops being a star by losing leadership in its niche. If that happens, a venture worth a fortune can suddenly become almost worthless. So what does that mean? If there's Amazon version 2 or different Netflix or something even better than either one of them that it is just takes them right out, then the value can drop quickly, be erased, if you will. So it's not something that's just set and forget. And that would be why people buy things like the S&P 500. I mean, I believe in diversification. I mean, I'm not here to say that only buying star business is all you should ever do. I'm not saying that at all. What I'm saying is that star businesses can provide maximum return levels. But the reason you buy things like the S&P 500, even things like annuities, insurance, real estate, other things, is to diversify your basket so that if you owned a star business that did really, really well, it's an Amazon, if you will, you also own other holdings that offset if there's a radical change on one of these holdings. Now, what we have built and been working on for years and testing and testing his theory and proving that, oh my gosh, it works great, is if you own an Amazon and 2 or 3 other or 5 or 10 star businesses, even if one was to start to fade, it doesn't mean anything's happening with any of the others. So, and we actually look at it from a point of some of them just aren't going to work out. Like, we're not looking for 100% probability at all. We're looking to be right, as often as possible, but knowing that not all of them are going to work out exactly the way we planned. But looking at this here, look at this, just these two. These are two that we've been using and looking at for years, the Netflix and the Amazon. And beyond the star principle, the reason I really am into those is just because of the market they're in, that it's exponential and very exciting and technology based. So it's not a brick and mortar type of situation. But as you can see, 8 times the market performance of the market, of the S&P 500. If you stretch it out to the maximum, something happened to my computer. Where would go? So there's two different holdings there. Let's go. Take Netflix out for a second. I just want to stretch out. Well, it's not working because we have the comparisons. Nice. What's interesting, I just saw a thing the other day, and then I'm going to get off of here. Look at the share price of Amazon back before the internet started taking off like crazy. $3.95 a share. And that was, what's the date? Oh, here's the date down here. 5/26/1997, $1.51 a share. Look at that. Now it's worth $1,819. But you can see it's kind of interesting with companies like Amazon, because they were a bookseller, and then the internet just got more and more commonplace, and also they started expanding all their offering and became the go-to here in the last few years. But you can see, even look back at the last crisis here, it was selling for $38.79. $38.79 on my birthday, 12/1/2008. My birthday's on December 1st. So I'm going to just do the math here, and then I'll wrap this up. So right now we're at 1819 divided by it closed that day at let's go December 15th. Closed at $51.56. 35 times. So $100,000 in that back in the midst of the crisis. would be worth $3.5 million today. 35 times. It's like a roulette wheel. I think that's about 35 to 1. Crazy. But this is an indicator of a high growth market with a market leader. There's a lot of companies that are in technology that are not market leaders, and their growth does not look like this. And that's why the Richard Koch group, our book, is just amazing when you think of what he's distilled there. I'm going to put Netflix in real quick. You can see Netflix right here. It's basically nothing until it got a little bump. This is in 2011. Where's it in 2011? $16 a share. Now it's, just does what it does. Amazing growth. And this is, again, fast growing industry with market leaders. What's interesting now is that Amazon Prime and their video is actually directly competing with Netflix. What makes Amazon so interesting is that they're always reinvesting back into their business, into different markets and so forth, which can be a little dangerous, but at the same time, they're not taking the money and just spending it, if you will. They're reinvesting to continue to diversify, just like what we were talking about earlier about diversifying. They're not stuck selling books or just selling items. They're into all kinds of things that they're in development. So it's just an interesting business story. But again, Richard Koch actually had put the link on another post to Richard Koch's blog post about the STAR principle, where he summarizes the book. It's in 2 or 3 pages, just really simplifies the concept. The only other thing that you could use this book for is if you own a business and you want to know how to make it a star, or to how to create it into something that's way more interesting than what it is now. I'm just saying, because there's a lot of great questions in here to ask of the business. And again, that comes from Richard Koch's business strategy background. Another one that he mentions in here, just some of them that he's mentioning, like Red Bull, Quicken, and these are leaders within their categories. And some of the examples they use, because of technology and everything else, are already outdated. Let me see the date of this book, when it was made or written, if you will. (2008). Interesting. He wrote this book right in the heart of the financial meltdown. It's of all books, and I've read, hundreds of investment and money books, this is the best one, the most concise, and its concept has been proven over and over and over and over. And so it is very good. And if you like to read his book. Otherwise, I hope you get some value out of what this is. A quick recap. What is the STAR principle? It's a company. It's based on the Boston Consulting Group. By the way, Boston Consulting Group also related into the Bain Company. If you know Mitt Romney, he was part of that. That's where all that came from. They used a lot of this concept. What's interesting is there's only one company in America that I saw that still uses this formula to an extent, and the minimum to walk in the front door is 75 million liquid. So I mean, it's very powerful. That's what made me excited about it, but it's provable. So market leader, to summarize, STAR principle, market leader growing by 10%, and an industry that's grown by 10%. Again, these are the minimums just to even qualify to be considered for a STAR principle as a company. Preferably way higher than that. When you have both of those factors in play and it is a definable niche that the company is a market leader, you have what he defines as a potential for geometric growth, where 1 + 1 doesn't equal 2, it can equal 100 or more. Next, summary wise, this on the left is 0, 10% growth, 20% growth, and on out, bottom down here. So stars qualify all three. Question marks are the follower, the second company. Cash cows are former stars, if you will, but they're in low growth industries, think insurance, those type of industries. And dogs they have low growth as a company and in a low growth industry. So with that, let me find out how to get back out of here. Facebook Live is new to me. Ooh. And I am going to end this live session. Thank you.